As you sit here watching this on Sunday, February 22nd, 2026, silver is trading at roughly $84 per ounce. And something just happened inside the global solar industry that could dramatically reshape the future of this metal, your portfolio, and the broader energy transition. This is not rumor, this is not social media panic, and this is not recycled market fear designed to generate clicks. What unfolded over the past few days is documented and verified reporting from Reuters, Market Screener, the Shanghai Metals Market, and multiple commodity research desks. Solar manufacturers are accelerating a large-scale shift away from silver and toward copper. The headlines are already framing this as the beginning of a demand collapse that could crush silver prices. But when you look deeper, when you examine the numbers, the supply data, and the broader macro landscape, the story becomes far more complex and potentially far more constructive than surface-level fear suggests. Stay with this analysis carefully, because by the end you will understand exactly what is changing, why it is happening now, how large the impact could realistically be, and why this development might not be the disaster many are predicting. On February 19, 2026, Reuters published a report that immediately circulated across global trading desks and investment banks. The report confirmed that photovoltaic panel producers are actively accelerating their transition away from traditional silver-paste metallization toward lower-cost alternatives, primarily copper. This shift has been researched for years, but the urgency behind it has intensified dramatically over the past 12 months. The reason is simple: price. Silver has rallied so aggressively that it has transformed from a manageable manufacturing input into one of the single largest cost components in solar cell production. To understand why this matters, you have to appreciate how critical silver has been to solar technology for nearly 2 decades. In virtually every commercial photovoltaic cell design, whether PERC, TOPCon, or heterojunction architecture, silver paste is screen printed onto silicon wafers to form ultrafine conductive lines. These lines, known as fingers and buzzbars, collect the electrons generated when sunlight strikes the silicon. They transport that electrical current outward so the panel can deliver usable power. Without these conductive pathways, the cell simply cannot function efficiently. Silver has been the backbone of solar conductivity. For many years, silver usage per cell was small enough that its price did not threaten manufacturing economics. It typically represented less than 10% of total cell production cost. Solar companies focused more on wafer thickness, module assembly, and balance of system efficiency. Silver was important but manageable. That changed when silver began its sustained rally in early 2024. Prices climbed from the mid-$30 range and continued rising with unusual strength. By mid-2025, silver broke above $100 per ounce for the first time in modern history. At its peak, it surged beyond $120 per ounce, representing gains of roughly 130 to nearly 150% within approximately 18 months. This was not a gradual appreciation, it was a sharp repricing of a critical industrial and monetary metal. Industries heavily dependent on silver felt immediate pressure. Solar manufacturing was particularly exposed because it consumes enormous volumes while operating on extremely thin margins. According to analysts cited in the Reuters report and supported by Market Screener coverage, silver paste now accounts for approximately 30% of total solar cell manufacturing cost. Just 2 years ago, that number was a fraction of its current level. Think about that shift carefully. Nearly 1/3 of the cost to produce a solar cell now comes from a single raw material whose price more than doubled in a short time frame. The global solar industry installed more than 500 gigawatts of new capacity in 2025 alone. Even a single-digit percentage increase in module pricing translates into billions of dollars in additional cost across the supply chain. Estimates suggest that elevated silver prices contributed to roughly a 7 to 15% increase in finished solar module prices over the past 12 months. That may sound modest in isolation, but at global scale, it becomes financially significant. The situation has been especially intense in China, which manufactures the majority of the world's solar cells and modules. Chinese producers have been engaged in an aggressive price war driven by overcapacity. By 2023 and 2024, module prices had fallen to record lows. Many companies were operating at break-even levels or even at losses, simply to maintain factory utilization and preserve market share. When silver prices surged on top of already compressed margins, the financial squeeze became severe. Manufacturers faced limited options: raise module prices and risk losing competitiveness, absorb the cost and deepen financial losses, or reduce silver usage and accelerate alternative development. Unsurprisingly, the industry chose the third path. The first approach is called thrifting, which means reducing the amount of silver used per cell without eliminating it entirely. This has been an ongoing trend for years. In 2015, a typical solar cell used approximately 130 milligrams of silver. By 2025, leading producers had reduced usage to roughly 50 to 60 milligrams per cell through improved paste formulations and more precise screen printing technology. However, there are physical limits to how much silver can be reduced before electrical performance begins to suffer. Conductive lines must maintain sufficient thickness and cross-sectional area to minimize resistive losses. Excessive reduction compromises efficiency. This limitation is what has pushed manufacturers towards substitution rather than mere reduction. Copper has emerged as the leading candidate. Copper is roughly 97% as electrically conductive as silver. More importantly, it is dramatically cheaper. As of late February 2026, copper trades around $4.50 per pound, compared to silver's $84 per ounce price. On a weight-adjusted basis, copper costs only a tiny fraction of silver's equivalent value. If manufacturers successfully transition to copper-based metallization at scale, material costs for the metallization layer could theoretically fall by factors approaching 100. Across projected global solar production of 500 to 600 gigawatts in 2026, potential annual savings have been estimated at up to $15 billion. That is not a marginal adjustment. It is transformative. Major industry leaders have acknowledged this reality publicly. Longai Green Energy has announced accelerated development of copper or hybrid copper-silver metallization systems targeting mass production as early as mid-2026. Other major Chinese manufacturers, including Tongwei, JA Solar, Trina Solar, and Jinko Solar, have invested heavily in similar research and development, though specific timelines vary. However, the transition is not simple. Copper oxidizes more readily than silver, particularly under high-temperature processing conditions common in solar manufacturing. Oxidation can impair electrical contact between the metallization grid and silicon, potentially reducing efficiency and long-term reliability. Mitigating oxidation requires protective barrier layers, modified atmospheres, or advanced paste chemistry. Each solution adds complexity. Copper paste also behaves differently during screen printing. Achieving ultra-fine line widths consistent with modern high-efficiency cells requires process adjustments, and long-term durability remains less proven. Solar panels are expected to operate outdoors for 25 to 30 years. Silver-based systems have decades of field data. Copper systems do not. For this reason, many experts expect an intermediate hybrid phase. Silver may remain at the silicon contact interface, while copper carries the main current in busbars. This hybrid model can reduce silver usage by 50 to 70% while preserving performance. Now, from a market perspective, this is where the real debate begins. Before substitution accelerated, solar accounted for roughly 17% of total global silver demand. In 2025, total silver demand was approximately 1.2 billion ounces, with solar consuming around 200 million ounces. If solar reduces silver consumption by 50% over the next few years, that could remove roughly 100 million ounces from annual demand. On the surface, that sounds deeply bearish, but that is only one side of the equation. Now we need to shift the focus from demand to supply, because this is where the broader silver story becomes much more complicated than a single industry substitution headline. While the solar sector may reduce its silver usage, the global silver market has already been operating under structural strain for several years. According to data cited by Money Metals Exchange, referencing the Silver Institute and Metals Focus, the silver market has recorded 5 consecutive annual supply deficits, and 2026 is projected to mark the 6th. That means for 6 straight years, the world has consumed more silver than it has produced through mine output and recycling combined. The projected shortfall for 2026 is estimated at roughly 150 million ounces or more. When you add up the cumulative deficit since 2021, the total exceeds 700 million ounces. That is not a small imbalance. It represents a substantial drawdown of above-ground inventories that previously acted as a cushion against volatility. When inventories are abundant, markets can absorb shocks without dramatic price movement. But when inventories shrink year after year, the margin for error disappears. The silver market today is operating with a thinner buffer than it had 5 or 10 years ago, and that changes how price reacts to new information. Global silver mine production has been relatively flat, hovering between 800 and 830 million ounces annually. There has been no major wave of new discoveries coming online to dramatically increase supply. Developing a new silver mine is not a quick process. From initial exploration to environmental permitting, financing, construction, and full production ramp-up, timelines often extend 10 to 15 years. Even expanding an existing operation can take 3 to 5 years and typically delivers incremental, not transformative, production increases. Another critical factor is that a significant portion of silver production comes as a byproduct of other metals such as copper, lead, and zinc. That means silver output is often tied to the economics of those primary metals. Even if silver prices remain high, producers cannot instantly increase supply unless base metal mining activity also expands. Recycling provides some flexibility, but it is not a dramatic swing lever. Scrap recovery contributes roughly 150 to 180 million ounces annually. Higher prices can encourage increased recycling, but growth tends to be gradual rather than explosive. It is unlikely that recycling alone could close a deficit of 150 million ounces per year. Now consider the math carefully. If the solar industry reduces silver consumption by approximately 100 million ounces annually over the next 2 to 3 years, but the supply deficit has been running near 150 million ounces, the market would still remain in deficit. The shortfall would narrow, but it would not disappear. Inventories would continue to be drawn down, just at a slower pace. This is the nuance often missing from alarmist headlines. Demand destruction in one sector does not automatically translate into surplus if the overall system is already undersupplied. The silver market does not exist in isolation. It is influenced by multiple industrial sectors and investment flows simultaneously. Beyond solar, silver demand continues to be supported by electronics manufacturing, electric vehicles, medical applications, industrial catalysts, and emerging technologies. Electrification trends remain powerful. Electric vehicles rely on silver in power electronics, battery systems, and charging infrastructure. Expanding data centers and artificial intelligence infrastructure require significant amounts of electronic components that utilize silver's conductivity. The rollout of advanced wireless networks continues to support electronic demand. Even within the renewable energy space, solar is not the only consumer. Energy storage technologies and wind systems incorporate silver in various components. While solar substitution may moderate one growth engine, the broader electrification movement remains intact. Another layer to consider is investment demand. Silver functions not only as an industrial input, but also as a monetary metal. It is influenced by inflation expectations, interest rate trajectories, currency stability, and geopolitical uncertainty. Although inflation has cooled from peak levels earlier in the decade, it remains above central bank targets in many economies. Precious metals continue to attract investors seeking diversification and hedges against purchasing power erosion. Interest rate expectations matter as well. Silver does not generate yield, so higher interest rates can create temporary headwinds by increasing the opportunity cost of holding non-yielding assets. However, as monetary policy shifts toward stabilization or eventual easing, precious metals often regain support. Even cautious signals from central banks can influence investor allocation decisions. Geopolitical risk continues to contribute to safe haven demand. Trade tensions, regional instability, and broader concerns about global economic fragmentation all play a role in shaping investor psychology. Gold has experienced strong central bank accumulation in recent years, reaching record purchase levels. While central banks primarily buy gold rather than silver, the strengthening of the overall precious metals complex tends to support silver sentiment indirectly. The gold-to-silver ratio offers additional context. With gold near $2,900 per ounce and silver around $84, the ratio stands near 34 to 1. Historically, the long-term average has been closer to 60 to 1. Some analysts interpret the compressed ratio as a signal that silver may be relatively expensive compared to gold. Others argue that structural supply constraints and strong industrial demand justify a lower ratio in the current cycle. Silver's price performance over the past 2 years has been extraordinary. Investors who accumulated silver around $30 per ounce in 2024 have seen gains approaching 180%. Such returns attract attention and build conviction among holders. That conviction matters because it influences how investors respond to corrections. Silver's market size is relatively small compared to gold or major equity markets. Annual mine production at current prices represents roughly $35 to $40 billion in value. That means relatively modest capital inflows can meaningfully impact price. Conversely, outflows can also amplify downside moves. This thinness contributes to silver's well-known volatility. Exchange-traded funds backed by physical silver continue to hold substantial inventories. Retail demand for coins and bars has remained solid. Online platforms and social media have broadened participation, bringing new investors into the market. Investment demand is driven by macro expectations and portfolio allocation decisions rather than industrial usage, which creates a separate layer of demand dynamics. It is also important to consider feedback effects. If reduced solar demand exerts downward pressure on silver prices, the economic incentive to substitute copper weakens. Manufacturers may slow the pace of transition if silver becomes less expensive relative to copper, especially if copper-based systems encounter reliability or efficiency challenges. Markets adjust continuously. This dynamic equilibrium is common in commodities. When prices rise sharply, substitution accelerates. When prices soften, substitution slows. Demand and supply react to price signals. Extreme scenarios often moderate because behavior changes in response to cost. From an investor's perspective, the key question is not whether solar substitution exists. It clearly does. The question is whether it overwhelms the broader structural factors shaping the silver market. Based on current projections, even a meaningful reduction in solar demand would not automatically eliminate the supply deficit. 6 consecutive years of deficit are rare. The cumulative drawdown of over 700 million ounces has reduced the inventory cushion that once absorbed volatility. Mine supply growth remains slow. Recycling has limits. Industrial demand extends beyond a single sector. Investment demand remains engaged. The silver market today reflects competing narratives. One emphasizes substitution and potential demand destruction. The other highlights structural scarcity and constrained supply. Both are valid considerations, but they interact within the same system. To fully understand the implications, we must now examine how substitution events have historically played out in commodity markets and what they have meant for long-term pricing. Because history provides context for interpreting present developments, and that is where the discussion becomes even more revealing. To truly understand what may happen next, we need to step back and examine how substitution events have historically influenced commodity cycles. When prices rise sharply and remain elevated, industries respond. They reduce usage, improve efficiency, and search for alternatives. But substitution does not automatically erase a material's long-term importance. In many cases, it confirms that the material has become scarce and valuable enough to force adaptation. Silver has experienced this dynamic before. In the late 1970s and early 1980s, silver prices surged dramatically. Industrial consumers reacted quickly. The photographic industry, which at that time represented one of the largest sources of silver demand, began aggressively reducing silver content per unit of film. Electronics manufacturers sought to minimize usage wherever possible. Some applications eventually transitioned to alternative technologies. When prices later corrected, demand patterns had changed. But silver did not vanish from industry. Instead, new technologies emerged that absorbed supply in different ways. Photography declined over time, yet silver found expanding roles in electronics, medical applications, advanced coatings, and renewable energy technologies. The key lesson from that period is that substitution events can alter the composition of demand without eliminating it entirely. A metal with unique physical properties tends to remain relevant. Silver's physical characteristics are difficult to replicate fully. It has the highest electrical conductivity of any element, the highest thermal conductivity, and exceptional optical reflectivity. It also resists corrosion and possesses antimicrobial properties that are valuable in medical and industrial settings. Copper may approach silver's electrical performance, but it does not exceed it. In applications where efficiency and reliability are critical, silver retains advantages. The solar industry's pivot toward copper is not an indictment of silver's utility. It is a response to cost pressure created by rising prices. Manufacturers operate on thin margins. When a single input cost grows to represent nearly 30% of total production expense, management must respond. That response does not negate silver's importance. It reflects economic optimization. It is also important to recognize that substitution requires capital expenditure. Developing copper-based paste formulations, modifying production lines, implementing protective barriers to prevent oxidation, and conducting long-term durability testing all require investment. Companies do not make those changes lightly. They do so when the economics justify the effort. If silver prices moderate significantly, the urgency behind substitution could diminish. Copper metallization research has existed for more than a decade. It was not commercially urgent until silver prices accelerated. That timing reveals something fundamental. The cost differential only became compelling after silver's rally transformed its role within manufacturing budgets. If prices had remained in the $30 range, widespread substitution would likely still be distant. Meanwhile, nothing about substitution accelerates new mine supply. Geological constraints remain. Permitting timelines remain long. Capital intensity remains high. Silver deposits are finite, and a large portion of production continues to come as a byproduct of other metals. Structural supply limitations are not resolved by reduced usage in one sector. The cumulative supply deficit exceeding 700 million ounces since 2021 represents real inventory depletion. That metal has been consumed. Rebuilding inventory levels would require sustained surplus production, which is not currently projected. Even if solar demand falls by 100 million ounces annually, the projected deficit of roughly 150 million ounces suggests that inventories would continue declining, though at a slower rate. Tighter inventories increase price sensitivity. In markets with limited buffer, relatively small shifts in demand or supply can trigger disproportionate price reactions. That dynamic introduces asymmetry. Downside moves may be cushioned by ongoing deficits, while upside catalysts could produce sharper advances. Investment psychology adds another dimension. Silver's move from roughly $30 in 2024 to over $80 in early 2026 has attracted a new wave of investors. Strong performance creates conviction. Conviction influences behavior during pullbacks. Investors who believe in structural scarcity often treat corrections as accumulation opportunities rather than exit signals. Silver's relatively small market capitalization compared to gold or major equity indices amplifies the effect of investment flows. Annual mine output valued at $35 to $40 billion is modest relative to global financial markets. It does not require enormous capital inflows to influence price. This thinness contributes to volatility but also creates opportunity for outsized moves. Exchange-traded funds holding physical silver continue to represent a meaningful portion of above-ground stock. Retail demand for coins and bars remains active. Digital platforms have expanded access, increasing participation across regions. Investment demand operates independently from industrial demand, driven by macroeconomic expectations and portfolio strategy. Macroeconomic factors continue to shape the precious metals complex. Inflation has moderated, but remains above long-term central bank targets. Interest rate policy remains a central variable. Silver, like gold, does not yield income, so shifts in rate expectations influence relative attractiveness. Gradual easing or stabilization in monetary policy tends to support metals. Geopolitical uncertainty also plays a role. Trade tensions, regional conflicts, and concerns about economic fragmentation sustain interest in tangible assets. Central bank gold accumulation over the past several years has reinforced the perception of precious metals as strategic reserves. Although central banks primarily buy gold, positive sentiment often spills into silver markets. The gold-to-silver ratio near 34-1 reflects silver's recent outperformance. Whether that ratio expands or tightens further will depend on future price action in both metals. Some analysts view the compressed ratio as a signal of potential consolidation. Others interpret it as evidence of structural change in silver's demand profile. The key point is that the solar substitution story exists within a broader ecosystem of supply constraints, diversified demand, investment psychology, and macroeconomic forces. It is one variable, not the entire equation. Markets adjust. If silver prices decline sharply due to substitution concerns, the economic case for copper weakens. Manufacturers may adopt hybrid systems rather than full replacement. If silver prices remain elevated due to supply deficits and investment flows, substitution may continue but not eliminate demand entirely. Commodity cycles rarely move in straight lines. They evolve through periods of expansion, correction, adaptation, and renewed growth. Silver's current phase reflects adaptation to higher price levels. That adaptation does not inherently signal collapse. As of Sunday, February 22, 2026, silver trades near $84 per ounce. That price reflects both optimism and caution. It incorporates awareness of substitution risk and recognition of persistent deficits. Could silver experience volatility in the coming months? Certainly. Markets digest new information continuously. Headlines can trigger emotional reactions, but long-term trajectories are shaped by fundamentals. Structural deficits, constrained mine supply, limited recycling expansion, diversified industrial demand, and sustained investment interest create a foundation that cannot be dismissed by a single industry adjustment. In the end, the solar industry's move toward copper is part of the natural balancing process within commodity markets. When a material becomes expensive, users adapt. When supply remains tight, prices remain supported. The equilibrium emerges over time. Silver has endured cycles before. It has faced substitution waves, technological shifts, and speculative surges. Each time, its unique properties ensured continued relevance in new applications. The current moment is not a binary turning point. It is a complex transition shaped by economics and innovation. For investors, the essential question remains whether long-term fundamentals justify continued confidence. Based on supply deficits, constrained production growth, diversified demand, and macroeconomic backdrop, the structural case remains intact. The narrative may fluctuate, prices may oscillate, but the underlying arithmetic has not disappeared. Every ounce not consumed by solar remains available for other industrial uses or investment, and every year of deficit continues to tighten the system incrementally. When the noise fades and the data is examined carefully, the picture becomes clearer. The solar substitution trend is real. The supply deficit is also real. The market will reconcile both forces over time. Silver's story is not ending. It is evolving. And as markets have shown repeatedly, evolution often creates opportunity for those who understand the full equation rather than reacting to a single headline.